The illusion of market control. Europe's proposed gas price cap is a politically expedient but economically flawed response to the energy crisis. The European Commission's mechanism to cap wholesale natural gas prices at Euro 275 per megawatt-hour represents a profound intervention in a market already distorted by Russia's weaponization of energy.
While politically necessary to signal action to a public facing soaring bills, the cap's design fundamentally misdiagnoses the core problem, a structural supply deficit, not pure financial speculation. By attempting to suppress price signals, the policy risks exacerbating the very shortages it aims to mitigate, potentially triggering a cascade of unintended consequences across the continent's interconnected energy grid and undermining the long-term transition to renewables.
Anatomy of a flawed mechanism. The cap's high trigger price and complex conditions render it both ineffective and dangerous. The proposed market correction mechanism is not a hard ceiling but a conditional instrument activated only when the month-ahead title transfer facility TTF price exceeds Euro 275/MWh for 2 weeks and trades Euro 58 above a global LNG reference price.
This technical design, intended to avoid disrupting global LNG flows, creates a critical vulnerability. In a genuine supply crunch, prices may not sustain this specific threshold long enough to trigger the cap, leaving consumers unprotected.
Conversely, if activated, it would immediately disconnect EU prices from global benchmarks, making Europe a less attractive destination for vital LNG cargoes and incentivizing suppliers to redirect shipments to higher-paying Asian markets.
The perilous supply-demand calculus. Capping prices in a deficit market suppresses the only mechanism that rations demand and incentivizes new supply. The current crisis is driven by a physical shortage of pipeline gas from Russia, which previously supplied 40% of EU imports.
A price cap does nothing to increase volumes of LNG or pipeline gas, it merely masks the cost. The critical function of high prices is to destroy industrial demand and accelerate conservation, a painful but necessary adjustment.
By artificially lowering the price signal, the cap risks sustaining demand at unsustainable levels, accelerating storage drawdowns. Furthermore, it strips utilities of vital hedging signals, increasing volatility and counterparty risk while discouraging investments in both new LNG infrastructure and alternative supplies that are essential for long-term security.
A strategic own goal in the making. The policy risks fragmenting the EU single market, undermining solidarity, and prolonging the crisis. The verdict is that the price cap plan is a strategic misstep that confuses symptom management with a cure.
Its most likely consequence is the diverting of LNG shipments away from Europe, deepening the physical shortage as winter progresses. This could force a chaotic reversion to uncoordinated national subsidies and protectionist measures, breaking the EU's unified front against Russia.
The projected outcome is a lose-lose scenario. Prices may be temporarily contained, but at the severe cost of supply security, potentially leading to rationing and forced demand destruction. The strategic next step must be a pivot to aggressive demand-side management, accelerated permitting for renewables, and collective EU purchasing of gas policies that address the root causes of the deficit rather than its financial manifestation.